Hi everyone! I'm Rose Concepcion. Welcome to the Money School. In this video, I will talk about the basics of common financial assets. What are assets? An asset is something that has value and that can be converted to cash. Examples of personal assets are your house, your car, and your savings and investments. Your net worth is calculated by adding up the value of all your assets, then subtracting all your liabilities. Or more simply, it's everything you own minus everything you owe. To have a positive net worth, your assets should be greater than your liabilities. To do this, we can try to choose assets that we expect to increase in value over time and perhaps also provide an income stream. We can also try to limit our liabilities to debt that has potential to earn us more money, such as borrowing for a business. Taking the time to analyze our finances so that we can choose our assets and liabilities wisely will help us increase our net worth and avoid getting buried in bad debts. So how do we choose our assets? To make better choices, we need to understand the differences among the most common assets available to us. First, let's talk about the liquidity of assets. Highly liquid assets are those that can be most easily converted to cash. Examples are savings and checking accounts, money market accounts, and of course, physical cash. Not as liquid but still fairly easy to convert to cash are stocks and bonds. Assets with low liquidity have value, but they cannot be converted to cash quickly. Examples are art and real estate. When examining which assets to accumulate in your portfolio, consider liquidity. Make sure you have enough liquid assets to cover emergencies in case you need cash fast. Otherwise, you may have to settle for lower prices on your illiquid assets due to your urgent need for cash. Next, let's talk about real assets versus financial assets. Real assets are usually more straightforward. You can see the thing of value. It is tangible. Examples are property, land, commodities, and precious metals. On the other hand, financial assets do not typically present you with tangible things of value. Rather, they are what we know as paper assets, containing a claim on an underlying asset. So why is it important for you to ensure that your portfolio contains financial assets? Because these assets are more liquid than real assets. I'll discuss now the most common financial assets. Well, first, there's good old cash. That's pure liquidity and still great to have on you. If, for example, there's a cataclysmic event like a zombie apocalypse, you'd need some hard cash as you run for your life. More realistically, if you're at the gas station and their card terminal is busted, cash is a lifesaver. So it's always good to have some cash on you. Most of our cash, though, we store with banks, in savings or checking accounts. The latter offers higher liquidity because there are no penalties on withdrawal amounts, but it also offers little to no interest. Savings accounts are good options for storing our cash because it's easy to withdraw and banks can offer competitive interest rates. Another storage option for our cash are money market accounts, which may offer higher interest rates than regular savings accounts. When we store our cash in bank accounts, we are lending the bank money. The bank will lend our money to borrowers, such as those who loan for their home, car, or business. In return for lending them money, the bank pays us depositors interest. However, this interest does not usually match inflation, and so we need to direct our money not only towards savings accounts, but also toward investments. The most common investment financial assets are bonds and stocks. To understand how these work, let's first talk about who usually needs them. Businesses. Corporations often need capital to expand their business. They have three options for acquiring this capital: use or raise their own money, borrow money, or issue shares. The first option, internal financing, will give owners peace of mind. But if they don't have the money available yet, raising it will take more time, especially if huge capital is needed. They will then consider borrowing. Borrowing via a bank loan is possible, but what if the volume they need exceeds what the bank can provide? The company will issue bonds, which is like an IOU. Individuals like you and me can lend money to the company by buying the bond. In return, the company will give us fixed income via coupon payments paid out periodically and set at an interest rate defined in the bond. The bond will also have a maturity date in the future, by which time the investors will get back the lump sum more or less equivalent to what they originally invested. This lump sum is called the face value of the bond. Bonds are fairly liquid because you don't have to hold them to maturity. You can easily sell them prior to maturity with the help of your banker. Governments also issue bonds to raise money for big projects such as road construction. Government bonds are considered less risky than corporate bonds, but they are also typically lower in yield. Now, let's go back to our company in need of funding. Instead of borrowing money, the company can issue shares, which represent part ownership of the company's stock. When you buy shares, you are betting that the company will grow and its value will increase, thereby increasing the value of your shares. If you've always wanted to reap the potential monetary benefits of starting a business, but are limited by factors such as lack of time or capital, then investing in stocks is one way to gain exposure to the exponential returns that business can give. When companies do quite well, they may decide to pay out part of their earnings, known as dividends, to their shareholders. What if they don't do so well? You could lose most of what you invested if you decide to sell your shares at a low price, but your loss will be limited to the amount of shares you purchased. If the business fails and the company racks up huge debt, you would not be forced to pay any of it. This is the concept of limited liability, which ensures that your loss will not exceed your original investment. On the other side of the story, if the business takes off, there is unlimited upside, and this is why many consider stocks to be a great investment. So, you may ask, what's a better investment? Stocks or bonds? Ideally, your portfolio should have exposure to both because these markets move in opposite directions. When the stock market is down, the bond market is up, and vice versa. To mitigate risk, put eggs in both baskets. Bonds are generally considered inherently less risky than stocks because if a company goes bankrupt and liquidates its assets, bondholders are first in line to get paid, whereas stockholders are last. Although less risky, bonds offer limited returns compared to stocks. So that ends my primer on financial assets. Paper assets may seem quite technical to people outside the financial industry, and so I hope I was able to explain the major ones, cash and cash equivalents, bonds, and stocks, in a practical way. I hope this video helped you guys better understand investing basics. Please hit the like button and subscribe to my channel. Let's learn more about money. Thanks for watching!